Investing in Stock Trading 101. Stocks are shares of a company. When companies need money to fund their operations, they issue out shares of stock. Typically millions, even billions of shares. Each share represents owning a fraction of a company. Companies offer these shares to buy on stock exchanges. The two biggest stock exchanges are the New York Stock Exchange and the Nasdaq. Stock exchanges act as marketplaces that allow investors to buy from and sell to each other. Now, investors wouldn't do this without a good reason. Investing in a company by buying a share can be rather profitable. When a stock increases in price, the investor can sell said stock for a higher price and gain a profit. However, the stock can also lower in price, which would force you to choose between either selling your share at a lower price or wait until your stock reaches your desired price. So it's important to do your research on a company before you decide to invest in it. The three most common strategies when stock trading and investing are day trading, swing trading, and long-term investing. A day trade is when you sell a share on the same day you bought it. In a swing trade, you buy and sell the shares within days or several weeks. And in long-term investing, the share is held for months, years, or even decades before being sold. For example, John is a swing trader. He's looking to buy and sell within a month for a quick profit. John believes that stock A, which is currently undervalued, will soon increase in price. He buys 3 shares at $50 for a total of $150. Within 2 weeks, the price has increased to $55 per share. John decides to sell all 3 of his shares, and he gains $5 per share. He now has $165. Alternatively, if Company A would have gone bankrupt, all of his shares would have become worthless, and then he would have ended up with $0. So how is a stock's price determined? There are 2 forces that determine a stock's price, and the first is how much demand there is for the stock, and the second is how many shares exist. The demand for the stock depends on many different factors. In the short term, demand for a stock depends largely on emotions, news announcements, and earning reports. So it is almost impossible to tell which direction the price will go. There can be published bad news about the company and good news. Earning reports can show that the company is currently performing well or underperforming. But in the long term, a stock generally raises in price and has a consistent demand if the company is doing well. Of course, the opposite is true if the company is doing badly. So if a company is doing very well, it is almost guaranteed to increase in price in the long run. But anything can happen. So how can you start investing in the stock market today? With the internet, investing has become a lot faster and more convenient. Most people today buy and sell stocks online through online brokers. With online brokers, you can buy and sell stock with just the click of a button. That is by orders of magnitude easier how it used to be, when stocks were bought and sold at physical locations. Fidelity and TD Ameritrade would be examples of such online brokers. Was this video helpful? Comment down below.